Okay, thank you very much, guys. I hope it was a way to start knowing each other and to also start, like gathering more insights on how, you see digital finance and its main aspect. And now it's my pleasure to actually start and kick finally the day with an amazing keynote speaker. We are very happy to have Stephen Cecchetti with us today. Stephen Cecchetti is Rosen Family Chair in International Finance at the Brandeis International Business School. Among other things, is also Vice Chair of the Advisor Scientific Committee at the European Systemic Risks Board, as well as a part-time professor at the UI. So he's part of the big family of FBF as well as SDFA. So I cannot think anyone better than Stephen because he has very provocative ideas and opinions on digital finance. I think it's amazing to start the day with this view. Stephen, the floor is yours.
Thank you. So I just discovered I'd forgotten about this. The biggest risk to digital finance is water. If you get things wet, they don't work. So, but more seriously, my 3 words were crime, competition first, and like that's actually way higher than everything else is crime, competition, and discrimination. So those are the things that I worry about. But I also was listening to the first things that everybody said, and I wrote down that there's the things that I thought were the most intriguing from my perspective, and someone said nothing new. I think that seems right. Confusing, I guess that's for the part that's new. Ungraspable, also for the part that's new, maybe. Evolution, I agree with that. That's for sure right. And innovation. So I do think we want to think about what's really new. When I think about digital finance, the word I used was a database. I think that finance is a database plus code, and the question is, what's that database? What are its protocols? How's it structured, and what's the code? Everything is a database and code. So when somebody comes to you and says they want to do blockchain, which I call blockchain baloney because I think it's like just another database with code. What's better about it? It looks worse to me. It's slow, it's costly, and it doesn't. And I'm still waiting for someone to show me a use case for it. But if I think about my own life, and this is related to Joseph's comment about his doing banking on his phone, I remember how excited I was. I'm by far the oldest person here, I'm sure. But I recall how excited I was in 1978 when I got my first ATM card. So before 1978, I was already an adult. I had to go into the bank and speak to a person to do anything, right? And in 1978, somebody handed me a card and said, now I can use this machine. And I was just like, this was great. It's not that I disliked the people inside. They're all nice people and they're trying to be helpful, but they have lots of rules and they have lines and it's time consuming and and then anyway, it was just not a great thing. So that was 1978. So my points, oops, I think we waited too long. Okay, this is the summary of the points that I'm going to make. I think, are these available to them? I think maybe
yes.
The slides. Okay, so you can not sit there. I always learn by writing. That's how I remember everything. So, but if you don't want to write everything down, you don't have to write everything down. So So the first point I'm going to make is that finance produces a set of services. It's a set of services that we've needed for a long time. We're sitting in Florence. We're not actually in Florence. We're sort of like a little outside of Florence, so that's a technical issue. But coming from a family there where people, that's 50 kilometers from here, I grew up thinking that this is where banking started. You can decide whether you believe that or not. You all have these stories about where you're from that, important things started there, right? But if you're from northern Tuscany, you think banking started here, or the Italian language comes from here. There's like a whole list of things like that that you just sort of think, oh, that's what this place is. Of course, the fact is that Italy does not have the most modern financial system around, but that's another story. But the current system has evolved over centuries since the Medici, and it meets the needs that we have efficiently. Technology is reducing transactions and information costs, but it's not changing activities. It's not changing what we do. Joseph's doing the same banking on his phone that he used to do by looking at the post and going to the bank and speaking to these nice people who now he doesn't have to go to speak to anymore. It's doing the same thing, right? The merchant that used to take paper banknotes and now takes electronic payments doesn't actually have to go to the hassle of going to the bank and dropping off the banknotes, which is risky, time-consuming, and also just counting it, all this stuff. But it's the same activity. It's the same activity. So we're not doing new things. We're doing the things we always did. We're just doing them differently. But these technologies do create threats to individuals and to the real economy. The threats may not be new per se, but they're new in the sense in the way that they're manifesting themselves. They're coming at us in new ways. Of course, again, that's the fact that the system evolves, which it has done since the 13th century, means that there are always new risks, because there are always new things that people can do to create risks. So, but what we need now, I think, maybe even more than we ever did, is a framework where we regulate by activity. So the way I think about this is that you're providing the same service, you create the same risks, and you want the same regulation. And you want that across the entire system. And the question is whether we can do that. The principles for this involve things like identity verification, disclosure, reporting, registration, and compliance. Again, not new things, if you think about it, not new things at all. So let me, this is the outline of what I'm going to try to go through. I won't have time to get to some of this, to the most outrageous things I have to say. I'll say them. I'll probably say them quickly. But here are the big questions that I think we all want to think about. Is technology influencing financial structure? And is it influencing how traditional intermediation is done? And do regulators then have to react to this? Okay. It's not so much about you and me and the services per se that are delivered to us. It's about the intermediaries and the technology and the structure. Okay, so here's my starting point. So sovereign bonds are Venetian. There's only one other Italian here. I don't think you're Venetian though. Oh, you're Venetian. Oh, okay. Okay, good. Okay, so you're from the place that created bonds, and they were actually collateralized by salt. It was you probably know this from your history. Double entry bookkeeping, that's nearby. That was Padua probably. Although these things you can have various claims. Consols were Dutch. Joint stock company, possibly Dutch, possibly British. Limited liability companies, that was a pretty great invention. Limited liability companies actually invented in New Jersey, but it's another story. And options pricing, I decided I had to have something from the 20th century. But most of these ideas are not from the 20th century, and most of the stuff that we use and we do, or we have modifications of them but they're not from the 20th century. We do need a legal structure that underlies all of this because we need to establish property rights. We need to establish things like what happens in default, what happens if we require recourse. Technology actually turns out to be on my list mostly about communication and about data, because that's what's related to finance. And again, you sort of look at this list, and there's nothing really new, over the last 50 years or so. Right? What's new now is just faster stuff that we have. It's the same stuff, but it's faster. I also remember my first personal computer. IBM issued its first PC in 1982, but they were very, very costly. Also, the other thing is that the nominal price of computers is basically constant over this period. So that's another interesting fact. But about 1983, I got a computer, but it had these big floppy disks and stuff. It was mostly good for playing games. It didn't have enough power actually to do what you needed to do. But these things are not, this is sort of like just an evolution. Now I'm going to show you three pictures, of which this is the most amazing picture, I think, from my perspective, in all of finance. This is a picture that estimates the unit cost of financial intermediation in the United States since 1865, or 1885, sorry. It's 130 years. So it's not really changing. If you look, people have done similar calculations for other countries, and what you basically see in those countries is that this is roughly the efficient frontier, and so you see them coming down to this frontier and then flattening out at this frontier. 1.5% to 2% of assets per year is what it costs us to run the financial system, and it hasn't been changing. That's amazing. Okay, now why hasn't it been changing? Has it not been changing because we just, as the costs down, is it demand or supply driven, right, that it hasn't been changing? Is it monopoly power? Is it rent-seeking behavior on the part of the suppliers? Probably. Is it also the fact that if the price were to drop, we would demand more of it, driving the marginal price up? That's probably part of it too, okay? But the question to ask is whether or not this time is finally going to be different, but it's hard to imagine given the story that I told about the fact that we started in the 12th century with the Venetian bonds. But actually we started with the Code of Hammurabi in Babylonia, but that's another story. So the question then is whether or not this time's finally going to be different. Some people think maybe so. What's that thing up there?
No, I just...
Oh, okay. So maybe so, but it's hard to imagine. Okay. Now, how is it that technology might change things? Well, this is one thing that people have looked at. Somebody mentioned access when they thought about finance. This is also a pretty incredible picture. That many of you are surely familiar of the cost of cross-border remittances, especially not for me and for you. Okay. This is really important to keep in mind. For those of us that have easy access to the banking system, cross-border payments are cheap. The cost is hidden inside of the cost of everything else, but at the margin, it's not very expensive to send money cross-border. But for somebody who's out there working, you're staying in a hotel, maybe the person who's doing the cleaning in the hotel and wants to send remittances back to their families. The cost remains around 5 to 6%. That's a lot, right? So if you're going to do a 200, this happens to be done in dollars. It's World Bank data. It's updated every quarter and it's flattened out. Okay, so you want to ask yourself, well, why is it that these costs are so high? Why is it that they're so high for these people but not for me and you? I think that there's an easy answer to this one. The first one I can't answer. This I can answer, and that's identity verification. It's know your customer rules. It's meeting anti-money laundering regulations, okay? So if I want to make a transfer, it's going to be bank to bank. My bank has already done the KYC on me, and they're doing the AML all the time on me, okay? Because I'm in their compliance process. And at the other end, if I'm sending the funds to you, my guess is all of you have different banks. My banks are in other countries now that I'm living in the UK, they're even outside the EU, which is kind of a drag, but that's another story. But if I send it to you, it's a different bank. Your bank has done it for you. The cost is minimal. If I can't easily verify my identity because I'm cleaning the hotel room, then it's expensive. Then I go in and I have to prove my identity. They have to check who I am, okay? So the question is whether technology is going to improve the ability to do compliance and identity verification. If it does, it will improve this, right? Let me make a side comment about access. There are a couple of reasons that people don't have access to payments to the banking system, if you think that somehow technology is going to give them access. The number one reason is they don't have any money, okay? So if you're poor, you have no access to the banking system. Giving you technology isn't going to change whether you're poor, okay? Another reason is you're a criminal. If you're a criminal and you don't have access to the banking system, I'm happy about it. That's good, and I don't want it to change. So hopefully technology isn't gonna change that. But be careful, and the third one is, of course, identity. If the reason I may not have access to the banking system is I have no verifiable identity, so no bank will do business with me. This one's more complicated, but it's about peer-to-peer lending. And so a number of years ago, this isn't that long ago, so many of you probably experienced this already. You saw the creation of peer-to-peer lending platforms, and you were wondering whether these things were gonna make any headway, right? You're saying, oh, you know, but then if any of you tried it, I don't know, I didn't try it. If any of you tried it, I sort of looked into it. I was a tourist, and I didn't ever do it. And one of the reasons I never did it was that I wasn't going to sit there and put like, you know, $5,000 or some amount of money onto this platform, pounds or euros, and then sit there doling it out 100 at a time. I would much rather watch sports. Right? This just looks stupid to me. It's like, it's an entertainment. It's not a financing technology. Okay? The other thing is you look carefully and you discover that these people are mostly doing debt consolidation transactions. They owe people money. They don't have access to banks to do debt consolidation. They're trying to do it on these P2P platforms. This picture here is a picture that shows you the average interest rate on the loans and the average return then after default rates on the vertical axis, okay? So if you've all learned at some point that says, oh, you know, if somebody is a very high risk, I have to charge them a very high interest rate. If I charge them that very high interest rate, then the probability of default at some point starts going up, not down, right? So the higher the risk, the higher the interest rate, the higher the default rate. So for a little while, risk goes up, I charge a higher interest rate, I'm compensated for it, but then at some point it starts curving and my return actually goes down because the default rate is now so high, the interest rate is now so high that I've raised it to the point where the probability of default goes up. And this is a form of adverse selection. Okay, what's going on here is that now you're only seeing the people that are the worst possible borrowers. And that's what happened to P2P lending. And so if you wonder why P2P lending is not taken off, it's because it's for people who can't borrow from banks and they're adversely selected. So these are my stable coins. I'll go over this very quickly. You've seen this. These are digital. You all know what stable coins are, especially those of you that are dealing with MiCA. And the question is whether or not the volume of these increased for a while. It peaked. It's come down a bit. We'll see what happens now with the U.S. authorities going after Binance, which is basically a criminal operation. But but we'll see what happens if it comes back down. But this is the bottom line here. So first of all, on compliance, it's still costly, so somebody's got to do it. Screening and monitoring is still necessary, and it's difficult. Banks do it well. Credit providers do it well. They do it cheaply. They have massive data sets. They're very good at doing credit evaluation for individual borrowers, and so it's not clear that technology makes this any better. On stable coins and crypto junk, private money issuance is always attractive. As one of my friends once said, people have always wanted to make money literally. Is technology going to reduce these costs? I've got to speed up. So what about the role of finance? So this is a list of services that finance provides us with. It's a list of services that the financial system has provided for a very long time. These services have been available to all of us or people like us for at least a half a century, probably longer, at the retail level. 100 years ago, 150 years ago, they may not have been available to just some average person, but they surely are now. And these are, I would argue that these are not changing. And so the question is not about the services, it's about their delivery. And so when I think about digitization, again, I go back to Joseph's comment about banking. I'm still using my bank to do the same things that I always did. It's just a lot easier now to do it because I can sit here and do it on my phone. Right? If I want to send you a payment, you just give me your mobile number and you'll have the payment in about 10 seconds. It'll hit your account. There's some counterparty risk associated with that. That's a complicated thing, actually. The back end associated with that payment is complex, but from the perspective of a retail customer, it's the same service. If I look, this is hard to see, and I'm not expecting you to see it. What I'm hoping you can see is how many X's there are in the box. On the down the rows, what I have is all those services I just showed you, and across the columns, I have different types of financial intermediaries. And so what I've got are asset managers, investment banks, depository banks, all the way over to central counterparties and custodians and people like that on the right. Okay. Doesn't matter much. The details here don't matter. What matters really is that some of these things, like collecting and processing information, are done by everybody, and some of them, especially payment system access, which is near the bottom, are done by very few of these entities. Okay, so the colors, the color gradation actually means something, and it's sort of what I have here, which you can read, I hope, which is that some of these things are broadly provided and some of these things are very narrowly provided. And if I stare at this picture for a while and ask myself, where do I see entry among, somebody mentioned that they like fintech. We would have to define what that means, but we see entry. We see people trying to slice up the services that individual intermediaries are providing. And the ones they're trying to slice off are more the ones on the bottom than the ones on the top. And the reason they're trying to slice those off is if they're narrowly provided, then the providers probably had market power, probably were collecting rents of some sort, and probably were doing it, therefore, at relatively high costs relative to their relatively high prices relative to their marginal costs. And so if I start slicing these things off, what I discover is that things like payment system access and the issuance of payment instruments are things that new entrants can do. It turns out equity and debt underwriting turns out to be pretty hard. So the reason it's narrowly provided is it's hard, not that, and people have tried though. I've seen evidence over the last 10 to 15 years of people trying to change the nature of equity and debt underwriting and make it much more auction-based. But every time you see that coming along, it never seems to get very far. Yeah. Okay, what about the impact of technology? So there are a lot of benefits, costs and expanded delivery of services, screening and monitoring costs can fall because I can provide more information. And it can improve access of savers and borrowers. I'll give you a very quick example of something that I think is that technology really does change. It's very hard to get a loan for a business, basically impossible. Nobody can borrow money. Like to a first approximation, you've got millions of businesses out there and nobody can borrow money. Well, it turns out that if you're on a dedicated platform selling products, like let's say the Amazon Marketplace, or something like it, and it's a dedicated platform that's then doing providing all of the payment services to you, that payments pipe, that means that the provider of the platform may be willing to make you a loan because they can make the repayment of the loan prior, they can give themselves seniority to everybody else. And so as your revenue comes in, they can say, oh, you know, the first revenue you get every month, I get repaid. After that, you get the money. Well, that's a form of collateralization that is something that you could not have done in the past, okay? And it does work. But if you look at the possible costs, there's undesirable discrimination, there's monopoly power, and risks of exploitation. There's also the creation of wasteful arms races, which exist because of technology. And my favorite one there is high frequency trading and high frequency equity trading, which seems completely dumb to me. And I would love to put speed bumps out there to force those people to actually slow down. Okay, so what about a framework for regulation? This is the point about same regulation, same activity, same risk, same regulation. How are you going to do that? Well, it's kind of hard, but you want to think about the regulatory objectives, of which we have sort of four general ones: consumer and investor protection, market efficiency and integrity, systemic stability, and crime prevention. And what you want to do, again, I'm going to just put this up here quickly, is the functions are on the horizontal axis. They're in the rows, and those regulatory objectives are in the columns. We tend to regulate by legal form of organization, and we do it by looking at the columns. But what we need to do is we need to look at the rows. So the question for all of you who are doing this is, can you figure out a way to stop regulating by legal form of organization per se and start regulating by activity? So if somebody engages in an activity, they get regulated a certain way. That would help a lot. So that's the challenge then, is to shift from regulating by institutional form to regulating by function. And I'm not sure we can see an easy way. An easy way to do that, but I'm going to leave that for people who are smarter than I am. I know I'm out of time, running out of time. So let me talk about crypto for just a minute. As I said, history is filled with attempts to invent money. I also think that there was a great quote from the U.S. Attorney General Merrick Garland a couple days ago at the press conference where they announced the settlement with Binance. You might ask yourself why someone would pay $4 billion to settle a lawsuit. It's like there must really be something there. And if you are interested in these things, I'm not a lawyer, but I do occasionally read legal filings. The one that the CFTC filed against Binance is amazing because it's basically just from wall-to-wall criminal operation. What Garland said was, using technology to break the law does not make you a disruptor, it makes you a criminal. And I think that that's what you need to think about when you look at this stuff. I don't see anything at all that is not either fraud, money laundering, or regulatory arbitrage. Nothing. So the question is there anything? This is only a narrow version part of what's going on in this program, so that's good. But let me just close by answering the question which is I think an interesting one, which is where is this all going? And what is it that we'll see 5 or 10 years from now in terms of financial structure, and what is it therefore that we need to be concerned about? One of the big concerns, of course, is competition, because these platforms that are out there, the big tech platforms, have these things called platform externalities. The more people that use them, the more valuable they are to the people who do use them. So this is why it is that everybody for a while used Facebook, everybody uses Amazon, everybody uses the same platforms to do the same things. It's because they can offer, they have forms of increasing returns. But there seem to me to be two possibilities for what finance is going to look like. One of them is that big tech is going to take over finance. I think that's actually unlikely. The technology firms don't seem to, the ones that we think of as technology firms, Amazon, Apple, Google, Facebook, those kinds of, well, Meta, I guess I'm supposed to call it, those kinds of people, they don't seem to be too interested in actually becoming financial intermediaries, because if they did, they would be subject to consolidated supervision, and they don't want to do that, okay? So that pretty much sucks from their perspective. What doesn't, however, is to be in alliances with large financial firms. But also, I want you to focus on the fact that financial firms are technology firms, and they have been for a long time, right? Individual large banks are spending more on technology per year than the entire fintech startup investments in their countries, okay? One bank is spending more. And so I think that you need to think of them as technology companies. And the government and all of you are going to be critical in how this plays out. I've used up my time, and I will stop here.
Fantastic. Thank you very much. Anyone has any question or reaction to Stephen's speech? I think there were many provocative, messages there. Oh, Samuel, yes, please.
Yeah, just to break the ice, I would say. No, I think you put quite rapidly in the trash the entity-based regulation, which at some point when you are combining some services and you are raising similar risks, I mean, even for big tech or digital finance, I mean, at some point the activity-based regulation may also have some issue, and at some point you may need to I would say, to provide for requirements in the legal entity which are providing the services, to have capital constraints or liquidity constraints to ensure that they can absorb the risks they are raising. And my second point that is just a compliment on the big tech. So we share I share the opinion that it seems like they do not want to go to banking that would trigger, I would say, regulation. But at some point, and I'm sure that there is this question of being, in the slice, as you mentioned, and to be, I would say, significant actor in distribution. And at some point, whether they should participate to the risk they may originate. We see that, there was some kind of partnership with Goldman Sachs or this way. And at some point, it could raise a question if those actors, become crucial or in the distribution of financial products without being banks or without being the risk.
Thank you. Before leaving the floor to Stephen, I would like to gather any other comments or question. Yes, please.
Yes, one of the things you mentioned were the systemic risks, but then you ended your presentation saying that this is still too small, the investment in fintechs, and of course also their activities. So how do we how do we convince supervisors, and especially financial stability people, that it is important to monitor what is going on digital finance?
Steven? I don't see. Oh, yes, please. No. No, please.
So I guess the question about whether or not big tech is going to require financial style regulation is an interesting one. I think they're going to do everything they can to not require it. And so what I would tell you is that if you think they're starting to get into an activity that would require it, then tell them and get them to stop. And because I think that you don't, I mean, otherwise it's going to become unmanageable for them. But I do think that there is one thing that I think that we do need to worry about, which is that will come up, and that is, I think, in the class in your week, and that is the concentration of of cloud service providers. There really are only a handful of cloud service providers. They do tend to be the big tech companies, not all of them. And they provide cloud services to financial intermediaries. Okay, so that's a problem. But who's that a problem for? Is that a problem for the financial service providers, or is it a problem for the financial regulators? I would force some amount of separation. Something like it's one of those cases where you have to be careful that you need a more varied ecosystem. But I think that's the one that I find. I mean, I think, again, you've all encountered this. There are only a couple of operating systems for these things out there. There are only a couple of operating systems that are being used for servers. The solar wind problem was a big one. So you run into things like that. But I do believe that those are national security issues. We've had discussions about cyber risk at the European Systemic Risk Board, and my not terribly well-received comment was that this was a national security problem, and that my nightmares are about the electricity grid, and that's where you should be putting. So this is about national security, and the financial system is clearly a concern, but you need to be doing this together with the military and the other national security providers. On fintech, so I guess the question is there are two ways of approaching this question. So one of them is from the traditional service provision side, where I think that people have these sandboxes and other things like that, and you put people in the sandboxes. You hope that cats haven't been there first, and there the question is whether or not those are actually working. I'm not sure whether that works. The other one is crypto, where people have been able to do things without just through regulatory arbitrage. I think crypto, the thing that I would focus on is keeping it from ever having any links with the traditional financial system. Make sure it's like it can be, I want it to be like it's on Mars. I really don't, and at that point, like, just do what you want to do. And if you want to treat it, I guess my favorite thing was there were people who were suggesting regulating it the same way you regulate gambling. Seems pretty good. But don't allow a lot of linkages with the traditional financial system. Thanks.
Thank you very much. I think we have run out of time. Now there is the first coffee break of the day. A bit of caffeine, right, is needed, but we are going to have an amazing panel after and a long day. So get your caffeine, but before, please give a round of applause to Steven for his keynote speech. Thank you. You can find coffee in the adjacent room here.